Welcome to the Broken Pie Chart Podcast, episode 277. I'm your host, Derek Moore, with me once again on this very important Fed Day, special Wednesday edition. We're recording Wednesday. I don't know when. We'll release it early, though. Jay Pestrichelli, CEO of ZEGA Financial. Jay, a fellow Jay, had some things to say today, and I don't know if he helped or hurt the markets.
Well, what you left out, it was CPI in the morning, and then you get Fed Day in the afternoon. We had a lot going on. PPI tomorrow. Of course, by the time this comes out, that will be out already. I think
people misread the CPI, but what do you think? I think they misread the implications.
Oh boy! Look, insurance on cars came down. Can I say that? That's a good thing. We spent a lot of time talking about insurance rates. Look, I did not think it was a misread on the CPI. Like, I thought that initial reaction was pretty good and accurate, and flat is a win. Like, even flat to slightly down is kind of a win. Like, not bad. It's not going up, is in other words, right? It's not the bad scenario, and the market seemed to like that. It was kind of prepared for the worst. I'm just going to say this. So we hit a new all-time high, right, today. Again, closed yesterday, then today. I mean, the market likes it. The market likes it. The market liked what Powell said. You know, we got a little wiggle, of course, during the press release, and you get a little wiggle after everybody kind of digests. But it was the least volatile Fed day I think I've ever seen. Like, we didn't get the big EKG that you normally get. I think the market was really like, okay, kind of all right, here what we thought, maybe, all right, only one cut, maybe. Like, market didn't move much on that number, Derek. And you know you could get 1% moves in 10 minutes on a Fed day. We didn't get any of that today. Very low-key day.
All right. I'll take a little contrarian point. I think it misread this. And if car insurance goes up 150% over the last year, I actually don't know what it was up.
I just heard somebody talking about it and we spent all the time talking about it last month.
But you know, if it goes up 150% and then from 1 month to the next, it doesn't go up anymore, it's still awfully darn high. I look at CPI Super Core. We switch. There'll be a new one that comes out that we sort of opine over. Super Core was negative month over month. It was minus 0.045%. So that's less than one.
I think that's good, no?
Well, it's good, but it's still 4.8% year over year. And that's down year over year from last month's 4.84, I think. But Supercore, which is basically sort of services, X housing, X food, X energy, it's still 4.8% year over year. Like, what about 4.8% does nobody not understand? That doesn't scream like, oh, let's cut.
Here's what you don't understand. It's going in the right direction.
Yes.
I know it's only a single data point, but
yes.
Maybe it's two, right? Supercore, a little lower in April, a little lower in May. Am I reading this chart right?
Well, sure.
So look. So the U.S., what are they getting? It's going in the right direction, and sometimes that's good enough. Now, it would be nice if it continued to go here, but I like negative. Negative's good.
All right. Well, the FOMC participants, though, they released their dot plot, and we know you should take these dot plots with a grain of salt because they are never right long term. Let me just say that unequivocally. They're never right.
Look, I wish my targets at the range look like this tight on this is a nice outline, right? If my target practice looked this good. It's all kind of going a little lower. There is a little weirdness in this. Whatever. This is never right. It's fun a little bit, and people glean as to how the Fed is going to vote. But we all, it's fine. I'd say it's irrelevant. Ignore that, as we always do.
I mean, the big news is 4 people. They basically priced in the median now is 1 cut based upon the dot plots. Last meeting, it was either 2 or 3, and 4 people now are saying there's going to be no cuts this year. That was the big news from the dot plot. But the next dot plot they do will be different, and then it will be wrong too. So
it's like, look, they change it every month. right? It moves. It's fine. Okay.
Well, I mean, what happened today with the Fed funds? So I looked at the December contract for the Fed funds future. And the way that this works is you get an implied interest rate from this, a Fed funds rate. So it closed the day right around 95. Nice even number. And that's nice because the way that you read this is you take 100 minus the price of the Fed funds future. That difference is 5. 5% is the implied December contract Fed funds rate. What happened though was,
by the way, when you see on CNBC or Bloomberg, they're kind of reading off real time what is implied in the cuts. It's this number that they're looking at.
This is the one.
This is the number they're looking at.
Yeah, and our audience can't see the chart, but basically it was right around 94.95 to start the day. The CPI number comes out, it jumps up. Now, when you see jumps up, it actually means the implied rate is going lower because it's 100 minus. So if it was 99, it would imply 1%. Okay, so it jumps up, it eases back off throughout the day as the Powell presser's going. And Powell basically said, we're not raising rates. We're not comfortable yet.
Or we're not cutting. Forget about raising, cutting.
Oh, yeah. They're not cutting. Yeah, they're not raising. They're not raising. That would be something, wouldn't it? Imagine if you just came out and was like, yeah, you know what? We're raising this meeting. Let's do it.
Actually, what would be funny is like, and what you should know is we decided not to cut or not to raise. People are like, wait a minute, was that even on the docket? Like that news? Good would be bad.
or he just, imagine his retirement, the last meeting. He comes out, he's like, yeah, we're raising 100 basis points. I'm not taking any questions. See you guys. That's it. I'm gone. Market would drop.
He's short the market that day when he does that.
Yeah. So I don't know. I mean, let's see. I will tell you that equity markets today, and it's only one day, but there was a gap up in the S&P 500 on the SPX, so the index. And there was a gap up, and there's an interesting pattern that formed. It looked like a gravestone doji for a while. Now it's an island top shooting star. And by the way, I'll caution people, by the time people listen to this, I mean, we already know what tomorrow.
You'll get 2 more bars in. Yep.
Yeah, at least something like that. Maybe we'll put that earlier than that. But this is a potentially bearish pattern, which tells you that the market jumps up, there's a gap. If it confirms an island top, you would expect a gap back down, shooting star. Anyway, I mean, this was really up until Powell's presser, and then you started to form this. But gosh, I mean, we've been up a lot last 2 days, so
Well, I would say somewhere around the 330 mark, the market pressed all the way back to the high, and then that last half hour is when, and then it went down more, Dirk. So it was not that it was up and then it went like the candle. While it's good, it gives you the open, close, high, low. You don't see some of that dynamic in there when you look at the minute by minute. I would say you're right. The market didn't love the presser, but it dropped 15 SPX points, 20 SPX points, right? So not awful, but then rebounded all of it, right? I was like, oh my gosh, we're going to make this run. We're going to close another high. It would have been nice if it was a full bar. You could have got the one of my favorite candlestick patterns is the kicker. I love the kicker, right? Gap up, close at the high. Next day, gap up, close at the high. If that happens, you're off to the races, right? That's why it's called the kicker. But we did not get that today. We got, like you said, when you hear something like the gravestone doji, that feels pretty ominous, right?
Yeah. Well, gravestone doji is where you have the long, thin candle line, the wick, and then a really just a narrow bar right at the bottom.
Yeah. And we didn't get that, right? We did close off the bottom.
So we had it for a bit. And I was
it was there. It was right there until the last 10, 15.
Oh, I have the screenshot. I had it in the doc. I had to delete it. I was like, we don't get to talk about gravestone dojis. No.
Well, you're right. Candlestick wise, that's not a great 1 day pattern. We'll see what the day with PPI has in it. And we'll go from
And we don't trade off 1 day patterns. So it's
irrelevant we to don't. Us.
You want to start? You want to start like a separate hedge fund?
If we only had a strategy that made tactical decisions. If only.
We don't. All right. Yeah. All right. Enough of that. So don't. Yeah. you're gonna have
new
me
high,
add
but
a
not
bunch of-
great. Like foreboding formation. Gotcha.
Yeah, I'll let you know when we know though. I mean, that's the thing with all these. Like when I used to go around the country and teach technical analysis, we would show that, and sometimes in real time, a market would do that, and people in the audience would be like, "Oh, this is great. Should I get short?" And I always remind people, part of these candlestick patterns are you have a confirming candle or price bar the next day or days afterwards. So you sort of might not know whether it's going to work until you know. But for long term, I mean, candles do, they provide some insight into the psychology of the markets. Jay, we have to clear up a couple wagers that you and I had. Hang on 1 second.
Okay.
I want to play a clip from last week. The other is sell the news, buy the rumor. The rumor is they're going to announce something next week, really cool, but it's going to sell off. And it's going to go back down to, the bottom end of the range. This is Apple, by the way. Flip a coin. Which do you want there?
I'm in the buy the rumor, sell the news camp that this is probably, again, I have no information on here. Happy to be wrong on all these market calls. But yeah, I say it's probably, I don't like the lower lows that it saw from October. Then we got lower in April. You got this gap up going on there. Yeah, this is all rumor. You got to sell the news when it comes out.
All right, I'll take the other side. It's breaking out to all-time highs.
There you go, Jay.
I think that sounded like a deep fake. If you didn't hear what I said, when Apple, has their event, it's gonna go down. It's already had its run up. And you said breakout to all-time highs. You couldn't have been more right. I couldn't have been more wrong. But that sounded like a deep fake to me. I'm not sure.
I would never play it if it was the other way. And if you would pick breakout, I would have taken it would bounce off the triple top.
Wow, Apple.
How about that?
No, I'm not sure. That's kind of an amazing pattern to see those last 2 days, just the pop. I will add, that sell-off that we saw today that started, that we talked about at the end of the day, it seemed to be all Apple pulling back, right off from 220 down to 213, that 7-point move on 200. So the 3% move down. That was that was timed, but the rest of the market did not do it, right? You look at the Nvidias of the world, you look at let me find Microsoft's pattern. You look at the big guys. Microsoft continues stronger. So I actually think it was just a little Apple twitch there, Derek, because pushing the market a little lower. But look, hands down, wow, Apple, wow. This is why you don't take Jay's advice on market direction. I think if we were keeping score, I feel terrible. Although it maybe you only bring up the ones that I lose. I'm not sure.
Well, I wouldn't bring up any ones that I lose. I will tell you, we also had another gentleman's wager. What comes first, 5,400 or 4,900? I'd like to take credit for that one as well. I didn't pull the tape though, Jay, for that one. On the S&P.
No, we're at 50. We passed through 5,400, closed at 5,421. Very nice.
Yep,
I'm happy to lose that one. I'm not happy to lose the Apple one, by the way. That one felt really slap in the face.
We're having fun with it. If you would have said it's breaking out to all-time highs, I would have taken the opposite. I would have said it's bouncing off triple top. And I even said there, flip a coin. I don't know if I...
You did. I heard the flip a coin. It was a little light, but we did hear that.
Okay. The thing that's interesting with Apple is it was almost like a buy the rumor, sell the news, buy the news. Because the day the AI announcement came out, so
it was down that day, right? It was down on the 10th.
It looked like it was. I almost messaged you and said, it looks like the triple top is in effect. Because they did their WWDC, Worldwide Developers Conference announcement. They announced a bunch of new stuff with their operating system, but integration with Apple Intelligence and OpenAI. So, but it was the next day. It was like...
Friday was down, and then Monday, Tuesday was like bang, because I was like, I kind of called it. And I really, in my mind, was like, I kind of called it. And then yesterday, I was like, oh my gosh. And then today, oh wow, right? I'm not sure where the top is on this, but this is...
we'll know when we know.
Very volatile.
Yeah, it almost seems like, sometimes you guys make fun of me because when the employment report comes out, I read the whole PDF while everyone else is commenting. And I don't know, to me, it was pretty clear what they announced. I don't know why the market didn't like it on Friday, but they loved it on Monday. Like, who knows? Who knows?
Yeah, I felt like there was something else over the weekend that played into that announcement, and I can't remember what it was that caused Monday to roll like that. By the way, good example here of a stock moving higher and having its implied volatility go up. Typically, people think, implied volatility and the premium on the options goes up as a stock is tanking. Not the case. Not the case. So Apple's implied volatility from Friday was at 21. Today, it's at, where are you out there? 26. So that's a pretty decent move for Apple's volatility. It's not earnings volatility, but it's in there. So nice little move. Nice, really nice move for Apple. And all those folks that are listening that have covered calls in Apple, I'm sure we'll be talking to you pretty soon about how we're going to roll or sell some shares to exit out of the call or what we're going to do in this situation. But we have a decent amount of calls that are at or in the money at this point on Apple now. So lots of fun conversations to have about that.
Let's kind of talk about that for a second, because I think in doing covered calls, a lot of people feel like, if my stock goes in the money, meaning it goes above the short call that has been sold, that it automatically gets called away. But that's not the case, Jay.
No, definitely not the case. So there's a lot of factors that go into this. Just because your call's in the money today does not necessarily mean you have to sell the stock. Doesn't mean you have to sell all the stock, right? So let's say, for example, with Apple trading at 213, you have the 210s. And let's be really, really tactical here. Like, let's say you had the June monthly 210s, right? So that's the June, 21st 210s. So those are trading at, let's say, $5-6, and Apple's at 213. There's $2.50 of what we call time value or extrinsic in those options. The holder of that long call, it's unlikely and unwise for them to exercise while there's that much time value left in that call, because they're going to lose that $2.50, right? Right now, that option's worth, let's say $5.50, $5.60, but it's only $3 in the money. Why would you say, let me get rid of something that's worth $5.50 and exchange it for something that's worth $3? Nobody would do that. So we watch those things to know if we're on the edge of getting called away or not. By the way, if we did get called away, we just made an extra $2.50 that we didn't really have any right to earn. So we don't mind if that happens. But now let's say it's expiration, right? And we got to make a decision here, and there's no time value left because there's no time left. Well, look, all it takes is $5 to get out of it. Let's say all it takes is $3 if I am where I am here, $3 in the money to get out of that, right? So if I sold, 100 shares at $2, right? It lets me close a whole bunch of calls at $3, right? So what do I mean by that? So if I sold 100 shares at $213, that's $2,100, $300. $21,300. If I just divided that by the $3 I have to get out, it's like that's 71 contracts I could cover by just selling 100 shares. So it's one of those things that once you get around here in the money, you definitely don't have to give up all your shares. Absolutely not. Okay, fine. We got to give up a little bit if I don't want to carry a debit balance. By the way, that's if I don't even roll it, right? I could take this thing in June and roll it out, 3 months, let's say to September, and now sell the 225s, unlock from 210 to 225. And that's actually a net credit, right? So there's a lot of things you could do here for those people that have covered calls on Apples. And we have a lot, by the way. We have a ton of Apple covered calls just in our general business that we manage through. Most of them are actually still out of the money right now. But if they are in the money, look, there's a lot of tactics that we have when it comes to option trading. Covered calls are the first strategy you learn. But they are not simple when you have to figure out what to do when you're in the money. Out of the money, it's easy, right? Let them expire, sell again, get your premium. In the money, Now you've got a couple different choices. Do you roll? Do you just cover it? Do you sell some shares? Hey, you could even like harvest tax losses on the short call if you wanted, right? Maybe sell a few shares that you had tax gains in. Like there's a lot of different ways we approach this. So if you have questions about this, Derek, they should email you, shouldn't they?
Yeah, that's best to do. Derek.Moore@ZEGAFinancial.com. That's DEREK.MOORE. Z is in zebra, E is in Eddie, G is in George, A is in Apple. Financially, you got to get correct. If you can't get that correct, you're not going to be able to email me. All right, Jay. I want to talk about just a little battle going on. We were talking last week, maybe Nvidia catches Microsoft. Apple's like, no, not today. Not today, folks.
Apple has retaken the number 2 spot in market
quietly in the night, Jay. Yeah, I mean, they were I think they got up above Microsoft again, and it was Apple, Microsoft, and Nvidia. According to Bloomberg, it looks like 3.22 trillion is Microsoft, 3.18 is Apple, and 2.97 trillion is Nvidia. Little battle going on here. I love it.
So what does it matter ultimately? Nothing, except it's great to see more than one single stock in the 3 trillion range, right? So having more stocks that kind of increase the market cap is better. But yeah, fun to kind of watch this. Who's number 1, 2, and 3, right?
Do you think that part of this too is I like it when the companies are jostling for the position because they're all going up. It's not that 2 went down a lot and 1 just was flat. Like I love this, like strength on strength. Let's go. Yeah.
Who can man up more, girl up more, whatever you want to call it.
Yep. Let's go.
I might have just come up with a bad term there. Sorry.
Probably. And we're not going to edit that out. We don't
probably should. Let's move on.
Speaking of bad takes.
Yes.
I gotta do this. So, oh boy. All right. So this is the public service announcement of the portion of the program. You should not listen to people on who are making market prognostications. Like it's a fool's errand. These people are there to sell books, to sell newsletters. And quite honestly, a lot of them who have managed their own money or manage money publicly have not done well. Well, Harry Dent's back at it, Jay. He said, reflecting on the recent performance of leading stocks like Nvidia, Dent warned that the positive trend will not last. Okay, seems fair enough. Stocks can't go up forever. Quote from Dent, I think we're going to see the S&P go down 86% from the top and the NASDAQ 92%. A hero stock like Nvidia, as good as it is a great company, goes down 98%. Boy, this is over, end quote.
That's worse than my Apple call, I think.
You think?
Well, Nvidia is going to go down 98%, Harry Dent says. Isn't Harry Dent Two-Face from Batman?
I don't know.
Maybe it's Harvey Dent. I could have it wrong.
This is from Chris Paras. I don't know the pronunciation, at Oakmark. He listed out Dent's misses. I know you want to hear these, Jay. We'll go through these. 1999 predicting a roaring 2000s with the Dow at 35,000. The reality, Dow peaked at 12,000 and the decade was a bust. 2006 touted the next great bubble boom. Investors enjoyed a short run before the 2008 financial crisis. I'm not going to read all these. 2009 published the Great Depression ahead after the market bottom. Missed the subsequent bull run. Let me do one. 2022 finally hit a single, a 35% downturn, but missed the year-end rally. And let's see what else. 2021 called a negative 45% crash by June, then doubled down with a negative 80% crash by Thanksgiving, and the market hit new highs. Like, I don't know. I mean, I hope nobody actually listens to all these clowns. I'm going to call them clowns. I did it. I'm sorry. But you just Google every year. And look, I mean, the markets do go down. We have recessions. And we may very well have another stock market crash or recession. I don't know when that's going to happen. That's why we hedge. But it's like, really?
Yeah, no, this is pretty... I mean, it's pretty stark. It's, clickbait. It's selling fear. It's anything's possible, but this is one where, there's the market, there's nobody taking this kind of position in the market. Certainly on the option side of things, like you could look at this and there's nobody who's, positioned to buy into anything like this. So, he's selling books, right? Is that what he's doing? And
I did look. I was like, I wonder if he has a fund that's public, and that's one of my pet peeves with a lot of these guys is they don't actually manage. They don't actually put to work publicly what they say. Like if that's his view, I imagine he's. I don't know what maybe he's all in gold or something. I have no idea. I did look. It looks like he had an ETF that launched in September of 2009. It was launched, and he was the co-manager. The funds. I'm reading this from this is a CBS News piece from 2013. Jay, the fund's track record was so poor that in August 2012, the fund was liquidated and sent to where it belonged.
Delisted in 2012. Yeah, I see that.
Yeah, and then I guess he had another fund that was. Had a very good up year. Let's see, from 2000 through 2004, the fund lost over 11% per annum and underperformed the S&P 500. Look, and that happens. There are plenty of people launch funds that underperform. It happens, but it's just I tried to see whether or not there was a long-term track record.
All right, look, you could believe Harry Dent, you could believe us. Make your own determinations, make your own decisions, right? Try to give you facts and you can make those decisions. I don't know if the market's ever dropped 98% before, so there you go.
Cumulatively, in the Great Depression, I'd have to look it up, Jay. Peak to absolute trough.
I think 98.
It wasn't 98, but it was.
That's why I said 98%. Yeah.
Yeah.
So 90 maybe. 90 maybe. I don't know. I have a problem. I always have a problem with people who make these types of predictions because they do it all the time. And if you say it enough, but I guess it sells books, right? It's actually, but it's harmful, right? Like it's harmful to people's investing, approach, right? It keeps you on the sidelines, keeps you from growing. Like, what are you supposed to do? Like, at least these days, Derek, you could buy a treasury. And if you think the government's not going to default, you have what we call, a very safe asset. I'm not going to say riskless. I guess there's nothing that's riskless entirely, but yeah, at least maybe that's where you sit and you get paid. But when interest rates are zero and you're sitting in those things, nope, you're making nothing. And there's inflation. You got to offset that. Like, just bad advice.
It's even if you're worried about stuff, you can buy and hedge. Oh yeah, we have something for that. We can hedge, and actually, that's the way to approach this, right? Be long with a hedge, but still, but hedging 100% of anything is, can get expensive. But right now it's not so expensive, so it's really not.
Yeah,
I agree with you, Jay. I think it's that type of prognostication again and again and again. I do think it's harmful, and it doesn't address anyone's individual circumstances. I mean, that's as an advisor. I mean, that we have to take that into account, when we're managing individual money. And no, it's not good. It's not good. Like, imagine if somebody had stayed in cash or completely out of the markets or whatever for
since Dent launched his fund in 2009.
Anyway. All right, Jay. So now that I keep winning all of our gentlemen's wagers, the market closed today. What do we say? Right around 54.30. Was that the close? I closed out
54.20. Yep, right around there. Yep, 54.21.
All right. So should we do? And I'll give you first choice on this.
What am I, glutton for punishment? And keep doing this? Yes.
Yes, absolutely. You should keep doing it.
All right. I'm going to play the gravestone doji approach here.
Oh boy, this isn't going to go well for you.
No. Because we just decided we do things every day.
Here's one for you. I'll take the over on this. I think the market touches 6,000 by the end of the year. I have no idea if that's going to happen or not. But
yeah, look, I think that too. But I'll take the other side of it so that we can have fun, and we can hope you win that one too.
Let's. What percentage is that? So that's
it's not much, right? It's like 11 from here.
11%. So yeah, okay.
Yeah, it's very doable.
By the way, if you would have taken 6,000, if I would have let you go first and you did, I would have taken the opposite, just to be on the other side. Because it doesn't matter. Like we buy, we hedge. You know what I mean?
Yeah, no, it's okay. And look, I love buying and hedging here. Market hits new high, great. At some point, we will roll up the hedges. We did roll some of the hedges up in our strategies over the last few months. Probably going to do it again as we continue to press the highs. That is kind of the nice thing about the way we ladder out our hedges, right? It's not all at the same time. They're usually spread out over a few different months, which gives you flexibility to take one off, roll little pieces at a time instead of all or none decisions. So all those things like laddering hedges and taking advantage of lower volatility. By the way, VIX almost below 12. What do we close on the VIX today? At one point, it was 1194. 12.04 was the close on the VIX today. I still think we touch a 10 handle, so that could be 10.99. But I still think we're in this low volatility regime. We'll see what your gravestone doji, almost gravestone doji, looks like. Would you say it's more of an evening star than it is a gravestone? Like what was the other candle?
I would call it a shooting star.
Shooting star, yeah. So, I think this is, I don't know how I got on this, but still talking about lower cost hedging, all kind of good stuff. It's why we like to do this, right? We'll be tactical on our hedges, not our market direction calls.
VVIX still below 80. It's weird. Do you see that there's a weird bar in the chart that says the low is 68? I don't think the low is 68 today in VVIX.
Nope.
That's wrong.
That's wrong.
Not. But it closed at 77.60. So yeah. I don't know how to take the other side of we're going to have a 10 handle at some point.
Just say we don't.
All right, I'll say we don't.
That was easy.
There you go. We don't have it by the end of the year. Is that what we're saying?
Yeah, sure. I'll even give you before September, because if we don't hit it before September, we're not going to hit it.
Okay.
The natural volatility in September and October is just that's normal, right? That's not a market call. It's just normally get a little more vol in September and October. So if we don't get it by then, we're not going to get it.
All right, fair enough. I'll got to keep track
made
of all
that
this.
Easier for you.
That's right. I got to mark down this episode. So when I win those two, I will play it back. Any recommendations though this week, Jay?
Recommendations this week. New Star Wars episode is out.
Okay.
The Acolyte. I've seen 3 of them. So far, so good. As a Star Wars person, it takes place 100 years before the kind of the original Star Wars 9 movies come out. So 100 years before Phantom Menace. So yeah, so far so good. As a Star Wars guy, I love it. All
right, I'm giving a pre-watch. I've heard about the Bratz documentary on Hulu about the Brat Pack. 1980s actors, Rob Lowe, that whole crew.
Emilio Estevez.
That might be interesting. So I'm going to check that out this week. But all right, that's it, Jay. We're going to do it short and sweet. It's a midweek episode. So we'll come back next week and see all the things that we got wrong.
Thanks, Derek.
All right. See you, Jay. See everyone. Bye.